The opening moments of the video frame the move in precious metals as something that feels sudden, overwhelming, and almost impossible to ignore. Gold, silver, and platinum are all surging at the same time, each pushing into territory that forces even casual observers to stop and look. Prices are not just drifting higher or grinding upward over weeks. They are jumping in a way that signals urgency. The host makes it clear from the outset that what is unfolding is not a minor fluctuation or a routine rally. These are new all-time highs, reached in a short window, and the scale of the move demands an explanation that goes beyond surface-level commentary. Almost immediately, the video challenges the dominant story circulating in headlines and social media commentary. The common assumption is that this kind of explosive move must be driven by fear, panic, or escalating global conflict. In many narratives, precious metals only surge when geopolitical tension reaches a breaking point. The host positions the audience to question that reflexive conclusion. He suggests that while it may feel intuitive, it does not fully align with what is actually happening in the market at this moment. The tone is deliberately corrective. Rather than amplifying dramatic explanations, the video signals that the real driver of this move is more structural and less emotional than many believe. The surge is presented as a result of specific market conditions coming together, not a sudden outbreak of chaos. This framing matters because it changes how the move should be interpreted. If the rally is misunderstood, future price behavior will likely be misunderstood as well. By setting this foundation early, the host establishes that the focus of the discussion will not be on sensationalism or fear-based narratives. Instead, the video promises to unpack why these metals are moving now, what the numbers actually show, and why the explanation that feels most obvious may not be the most accurate. The opening section does not try to predict outcomes or offer advice. Its purpose is to reset expectations and prepare the viewer to examine the surge through a more precise lens, grounded in what the host sees as the real forces behind the move. Gold's move is presented in the video as both striking on its own and important for what it represents in the broader context of the market. The host points directly to the numbers to anchor the discussion. Gold is reported as being up 1.85% on the day, trading around 4,922.90, with a session high reaching approximately 4,929.20. These figures are not framed as abstract milestones, but as evidence that gold is behaving with unusual strength, even by its own historical standards. What stands out in the way this performance is described is not just the absolute price level, but the pace and confidence of the move. The host emphasizes that gold is not hesitating or struggling at these levels. Instead, it is advancing decisively, suggesting that the buying pressure behind the move is both broad and sustained. This is important because gold often slows or consolidates when it reaches psychologically significant prices. In this case, the market is pushing through with little visible resistance. Another key point that the video stresses is how gold is performing when viewed through an inflation-adjusted lens. Rather than focusing solely on nominal prices, the host highlights that gold's current strength remains exceptional even after accounting for inflation. This framing reinforces the idea that the move is not merely the result of currency debasement over time, but reflects genuine demand and repricing in real terms. The implication is that gold is not just keeping up with inflation, but outperforming it in a meaningful way. The host also uses gold's performance to challenge the idea that the rally is fragile or easily reversible. By pointing to the combination of percentage gain, elevated trading level, and strong session high, the video suggests that gold is not behaving like an asset caught in a temporary spike. Instead, it is acting like one that is being repriced by the market under current conditions. This distinction matters because it influences how pullbacks or pauses are interpreted later in the discussion. Throughout this section, gold serves as a benchmark. Its movement provides a reference point against which silver and platinum will later be compared. By establishing gold's strength clearly and methodically, the host sets up the idea that what is happening across the precious metals complex is not random. Gold's behavior is presented as deliberate, measured, and grounded in market mechanics rather than emotion, reinforcing the central theme that this surge has a more technical and structural foundation than many assume. Silver's movement is presented as sharper, faster, and more visibly aggressive than gold's, even though both are moving in the same direction. The host notes that silver is up 3.31% on the day, trading around 96.31, and that it nearly touched the next level just below 97. This proximity is emphasized to convey how quickly silver is advancing and how little distance separates it from another psychological threshold. The implication is that silver is not lagging behind gold in this rally, but in some respects, accelerating ahead of it. The way the video frames silver's surge highlights its reputation for volatility without resorting to exaggeration. Silver is portrayed as responding more dramatically to the same underlying forces that are lifting gold. The percentage gain alone reinforces this idea. as silver's move is nearly double that of gold on the same day. This contrast is not framed as a competition, but as a reflection of how silver typically behaves when market conditions align in its favor. The host keeps the focus on observable price behavior rather than speculation. The near touch of the higher level is mentioned not as a prediction, but as an illustration of momentum. Silver is shown pressing upward, testing boundaries, and doing so in a way that suggests active participation from the market. This reinforces the broader theme that the rally is being driven by tangible buying rather than thin or erratic trading. Within this segment, silver also begins to be framed as a metal with a distinct narrative compared to gold, even though that point is developed more fully later in the video. Here, the emphasis is on how silver's price action is drawing attention precisely because of its speed and magnitude. The host treats this as an important signal, suggesting that silver is responding strongly to the same conditions influencing gold, but with greater sensitivity. The mention of summit metals appears briefly in this context, referenced as a resource for buying or selling silver. It is not used as a promotional pivot or call to action, but rather as part of the factual flow of the discussion. The inclusion serves to ground the conversation in real-world market participation, reinforcing that the price movements being discussed have direct implications for those actively involved in the physical market. Overall, this section positions silver as a key component of the broader precious metal surge. Its rapid rise, significant percentage gain, and proximity to higher levels are presented as further evidence that the move underway is coordinated and systemic, rather than isolated or driven by a single headline. Silver's behavior strengthens the case that the rally has depth and momentum across the metals complex. Platinum is introduced as the most dramatic performer of the day, standing apart even within a market already defined by strong moves. The host describes platinum as the clear standout, noting that it is up 6.16% and has gained roughly 153 in a single session. This framing immediately establishes platinum's move as exceptional, not only relative to its own recent history, but also in comparison to gold and silver on the same day. The video emphasizes the speed and scale of this advance. Platinum is reported as trading around 2,646 after reaching a session high near 2,751. These numbers are not treated as incidental details. Instead, they are used to illustrate how forceful the move has been, with platinum covering a significant amount of ground in a very short period. The host underscores that this is not a slow, grinding advance, but a decisive jump that demands attention. By labeling platinum as the day's biggest winner, the host reinforces the idea that the rally in precious metals is not uniform. Each metal is responding differently, with platinum exhibiting the most explosive behavior. This distinction is important because it suggests that the underlying drivers of the rally are interacting with each market in unique ways. Platinum's sharp move adds another layer to the broader picture, showing that the surge is not limited to the most commonly discussed metals. The discussion avoids introducing new explanations or narratives specific to platinum. Instead, the focus remains on the observable outcome: a large percentage gain, a substantial one-day price increase, and a strong session high. The host allows the numbers themselves to carry the weight of the argument, reinforcing the documentary tone of the analysis. Platinum's performance also serves a structural role in the video. After examining gold's steady strength and silver's rapid acceleration, platinum's outsized gain completes the picture of a precious metals complex moving in unison, but at different intensities. This reinforces the central claim introduced at the beginning. Something broader is happening beneath the surface, and it cannot be reduced to a single, simplistic explanation. By the end of this section, platinum stands as confirmation that the surge is widespread and powerful. Its one-day move acts as a punctuation mark in the narrative, signaling that the forces at work are strong enough to produce extreme outcomes across multiple metals simultaneously. This sets the stage for the next part of the discussion, where the video turns to the competing explanations for why this is happening now. The video then turns to the explanation that has been circulating most widely outside of the host's own analysis. In many reports, the surge in precious metals is being attributed to rising geopolitical tension, uncertainty, and fear. This narrative assumes that investors are rushing into gold, silver, and platinum as a defensive reaction, anticipating escalation and instability. The host acknowledges that this interpretation is common, but makes a clear effort to separate it from what he believes the market is actually signaling. Rather than accepting the geopolitical explanation at face value, the host challenges its timing and relevance. He argues that the idea of intensifying global tension does not align cleanly with current conditions. In his view, the situation being described in headlines is not one of accelerating conflict, but of easing pressures. This contrast is presented calmly, without dismissing geopolitics entirely, but also without granting it primary responsibility for the price action being observed. The host frames this as a problem of misattribution. When prices move sharply, the instinct is to attach the most dramatic possible cause. Geopolitical tension offers an easy story, one that feels intuitive and emotionally satisfying. However, the video suggests that relying on this explanation obscures more immediate and measurable forces at work in the market. By focusing too heavily on fear-driven narratives, observers risk misunderstanding both the nature and durability of the rally. This section does not attempt to prove that geopolitics are irrelevant. Instead, it emphasizes that the current price behavior cannot be explained adequately by that factor alone. The host points out that if easing tensions are being observed, then attributing a powerful, coordinated surge solely to fear becomes logically inconsistent. This inconsistency is used to justify a deeper look at alternative drivers. By setting up this contrast, the video prepares the viewer for a shift in focus. The discussion moves away from broad, external narratives and towards specific market mechanics that can be observed and measured directly. The rejection of the geopolitical explanation is not framed as controversial, but as necessary groundwork. It clears space for the argument that the real cause of the surge lies elsewhere, in forces that operate quietly but exert significant influence across all three metals at the same time. The core explanation offered by the host centers on market mechanics rather than external drama, with particular emphasis on currency movement. He points to the slipping dollar index as the primary force aligning the precious metals complex. The dollar index is cited at approximately 98.32, down about 0.57%. This decline is presented not as a background detail, but as a central driver of what is unfolding. The host frames this weakness in the dollar as a condition that directly supports higher prices in gold, silver, and platinum. The argument is constructed carefully. A softer dollar lowers the relative cost of precious metals and increases their appeal across markets that transact in other currencies. The host treats this relationship as straightforward and mechanical, avoiding speculation or broader macroeconomic storytelling. The emphasis remains on what can be observed in real time. The dollar is weakening, and metals are responding in a coordinated way. Alongside dollar weakness, the host also references technical buying as part of the explanation. This is not elaborated into a complex trading discussion, but it is acknowledged as a contributing factor that helps explain the speed and decisiveness of the move. The implication is that once certain levels were approached or crossed, buying activity intensified, reinforcing the upward momentum already supported by currency conditions. Importantly, this section reinforces the earlier rejection of the geopolitical narrative. By presenting dollar weakness and technical factors as sufficient explanations, the host argues that there is no need to invoke fear or crisis to understand the rally. The metals are responding to clear, measurable inputs. This framing portrays the surge as rational and structured, rather than emotional or reactive. The host's tone remains analytical and restrained. There is no suggestion that the dollar's decline is sudden or chaotic, only that it is meaningful enough to matter. The metal's response is framed as logical within this context. When the currency underpinning global pricing softens, assets priced in that currency tend to revalue upward, and the video positions the current rally squarely within that dynamic. By the end of this section, the explanation feels complete in its own terms. The viewer is left with a clear causal chain that connects dollar weakness and market behavior to the observed price action in metals. This serves as the structural backbone of the documentary's argument, grounding the dramatic price moves in forces that are tangible and observable rather than speculative. With that framework established, the video turns briefly toward how the host interprets near-term fluctuations within this broader move. Rather than framing short-term setbacks as signs of failure or reversal, he presents them as a normal feature of the current environment. Pullbacks are described not as warnings, but as moments that fit naturally within a strong trend driven by the conditions already outlined. This perspective reinforces the idea that the rally is not fragile, even if prices do not move upward in a straight line. Within this context, the host mentions a projected level for gold, citing a target around 5,187. This figure is not introduced as a promise or prediction guaranteed to unfold, but as part of the way he is thinking about the market's potential within the current setup. The projection is treated as a reference point rather than an endpoint, helping to illustrate how far the move could extend if the same forces remain in place. The emphasis remains on mindset rather than forecasting. By framing short-term setbacks as opportunities rather than threats, the host signals consistency in his interpretation of the market. The same logic that explains the initial surge is applied to periods of hesitation or consolidation. Nothing in this framing suggests that the underlying drivers suddenly disappear when prices pause. This section is notably restrained. There is no attempt to outline timelines, catalysts, or scenarios beyond what has already been discussed. The host does not introduce new data or expand the argument into broader speculation. Instead, he keeps the focus narrow, reinforcing that his outlook is derived directly from the same observable factors that have already been identified. In doing so, the video maintains its disciplined tone. The mention of a higher level for gold serves to contextualize the strength of the current move without turning the discussion into a forecast-driven narrative. The takeaway is not where prices must go next, but how the host interprets movements along the way. Short-term weakness in this framing does not contradict the surge already underway. It fits within it. The discussion then narrows to a comparison within the precious metals complex, focusing on how the host differentiates silver from gold despite their shared upward momentum. While gold is presented as strong and structurally sound, silver is described as having a more compelling fundamental narrative at this stage. This distinction is not framed as a rejection of gold, but as a relative assessment based on how each metal is positioned within the current environment. The host links silver's appeal to the same forces already identified earlier in the video. Safe haven flows are mentioned as part of the backdrop, but the emphasis remains on how silver appears to benefit more visibly from dollar weakness. The implication is that silver's price behavior reflects a heightened sensitivity to these conditions, which aligns with its sharper percentage gains and faster movement compared to gold. This section reinforces the idea that the rally is not uniform in meaning, even if it is coordinated in direction. Gold is treated as the anchor, steady and resilient, while silver is framed as more responsive and dynamic. The host suggests that this responsiveness gives silver an edge in the current setup, at least in terms of narrative strength, without expanding beyond what has already been stated elsewhere in the discussion. Importantly, the video avoids introducing new justifications or broader economic arguments. The case for silver remains tightly bound to the factors already outlined: dollar weakness and safe haven interest. By keeping the reasoning consistent, the host strengthens the coherence of the overall argument. Silver's stronger narrative is not presented as a new development, but as a logical extension of the same conditions driving all three metals higher. The tone remains analytical and comparative rather than promotional. Silver is not elevated through hype or dramatic language, but through contrast. Its sharper move and perceived sensitivity are allowed to speak for themselves. This reinforces the documentary style of the video, where conclusions are drawn from observed behavior rather than speculative storytelling. By the end of this section, silver occupies a distinct place in the narrative. It is positioned as a metal whose fundamentals, as described in the video, make its current performance especially notable. This sets up a natural transition into the closing portion of the documentary, which shifts away from market interpretation and toward a concrete showcase of recent acquisitions mentioned by the host. The closing portion of the video shifts away from price interpretation and returns to tangible examples drawn from the host's own recent activity. This segment functions as a practical illustration of how the current market environment is being navigated without altering or expanding the broader argument. The host begins by showcasing hobo nickels he received from a community member, drawing attention to their craftsmanship and individuality. The focus is on their quality and the fact that they are available for sale, presented as part of an ongoing exchange within the precious metals and coin collecting space. From there, the host describes recent purchases made directly from the United States Mint. These include uncirculated Morgan dollars, peace dollars, and a George Washington presidential medal. Each item is mentioned plainly, without embellishment, and the emphasis remains on the acquisition details rather than any symbolic or historical significance. A key point repeated across these examples is that they were obtained below spot price, reinforcing the idea that even in a rapidly rising market, opportunities can still exist under the right conditions. The segment continues with a mention of a completed roll of 2010 proof Roosevelt silver dimes purchased from a local coin shop. As with the other acquisitions, the host highlights that these were also bought below spot price. This repetition serves a clear purpose. It underscores a consistent theme of disciplined purchasing rather than reactive buying, aligning with the earlier framing of the rally as structured rather than chaotic. This closing section does not attempt to draw new conclusions or revisit earlier explanations. Instead, it grounds the discussion in real observable actions that reflect the host's approach within the current market. The items mentioned span different forms of silver-related products, but they are all tied together by the same practical detail: price relative to spot. This detail is allowed to stand on its own without interpretation layered on top. By ending on these examples, the video brings the discussion full circle. After examining why gold, silver, and platinum have surged and challenging common misconceptions about the cause, the host closes with a reminder that market participation is not only about price charts and narratives. It also involves concrete decisions made within the realities of pricing and availability. The documentary concludes without speculation or instruction, leaving the audience with a clear picture of both the market dynamics discussed and how they intersect with real-world transactions.